Good afternoon, everyone. Welcome. I'll be presenting my 2023 Q2 housing market update. I'm Kathy Fettke. If you don't know who I am CEO of Grow Developments and co-founder of RealWealth, but I'm guessing you knew that. Hope everybody's having a great start to your summer. It's cloudy here, but that's June gloom in California. Okay, well, let's go ahead and get started. Welcome everyone to my mid-year housing update. So much going on. I'm excited. I love doing the research for these because I find really cool charts and stuff. So I'm going to get on to the next slide. Let me make sure it's working. There we go. And of course, here is our disclaimer that anything I say today, please just use for your own due diligence. You consult with your personal accountant, tax advisor, and attorney to discuss your specific situation because everyone is in a different place, and this information will be different for everyone. Of course, past performance is no guarantee of future results, and real estate purchases are subject to investment risk, including the possible loss of money. While every effort is made to maintain accurate and current information, the possibilities of errors or updates or pandemics always exist. We have to add that one in there now. Okay. Real quick, we have some upcoming webinars and events that we're super excited about. I wanted to make sure you knew about. We have our webinar on Thursday of next week with Tampa. You can register for that now on the website if you just go to realwealth.com or realty.realwealth.com. And there's some really exciting things and different strategies that our Tampa team is presenting to investors today. Tampa is just one of those markets that's holding up so well, so strong during this recovery time. And it's one of the markets that actually, I think in the last update, it increased year over year in value, the average price by, I think, 5%, whereas nationwide, it was a negative 1%, which is still astounding considering all that's been happening. And then a week later, what's happening with interest rates? We're going to have Graham Parham on to talk about where interest rates are and where they're headed. I'll be giving some ideas on where I think that is. Of course, like I said, you never know what's coming next, but he will give an update on the kind of the loans that are available today. And then the big news is, I'm sure you've heard about it, but we have our live event in October 6th and 7th. The 6th is kind of an evening cocktail party and with food. And on the 7th, we'll be flying in our teams from all over the country to present to you and tell you what's going on in their markets and what kind of properties are available and deals and what the rents are coming in at. And you'll just get an update on about 10 different markets and get to meet the teams. Plus, it is our 20-year anniversary, so we'll be having some longtime members there, hopefully up on stage on a panel so they could share with you, what's been going on in 20 years. For some people, our original strategy was to buy 10 properties, use the cash flow from each property to pay off one house, and then use the cash flow to pay off the next house and so forth, so that in 12 to 15 years, you'd have your whole portfolio paid off. And I know some of our members who started back then have done that and have become financially free. So it's fun to be able to talk to them and see that this stuff works. And again, registration for this, we've been talking about it, but it will be open next week. So watch your inbox. We're super excited to see everybody live and in person again. Okay. Let's see. So to get started, many of you know that I started my career when I graduated from San Francisco State in broadcasting and worked in newsrooms in San Francisco. And when I got into real estate, I sort of became the voice of like what's going on, what do these headlines mean? Because my experience as a news reporter and writer was, we had to cover topics that we didn't really understand that well. So, I think I've told people that I had 10 minutes to read and understand Hillary Clinton's new healthcare plan. This is aging me, but that's what was going on. And we had very little time to read and review and report. So this is often the kind of stress that reporters are under. They have to get your attention. So the headlines are crazy and usually led with fear. So I really like being on this side of the business where I can be the expert coming in and helping these news reporters interpret the headlines. So I've been doing that and continue to do that. And we're going to take a look at the headlines of the first half of 2023, which have been insane. This was supposed to be a little bit of a calmer year, wasn't it? After the last few crazy years, but maybe not when the Fed decided to raise rates and everybody thought we were heading into a major recession this year. And it sure seemed that way early this year when all those rate hikes really caused stress on the banks and we saw bank failures. It was feeling a whole lot like 2009. And of course, the Fed came in and fixed that, at least is what they're saying, which to me means that probably printed more money. And then right after that, the Fed raises rates again in spite of those bank failures, which is the rising rates is what caused the bank failures. So we're living in a very strange time. But now that I'm in my 5th decade, I could say that every single decade has had a little bit of drama with politics and government. So that's just how it is. And we all survive, right? And real estate survives the best. So of course, the headlines for the last year, ever since the Fed said they were going to start raising rates a year ago, most people were predicting a recession, and some thought it was going to be a massive one. We've heard big name hedge fund managers saying it's going to be really bad. And these were the headlines that we've seen for the past year, and that's terrifying, of course. And then, you add to it that in spite of all the debt that we have and all the concerns about a recession, our politicians can't figure out how to cut the budget, so they just keep raising the debt ceiling or just ignoring it or whatever. So this was obviously another terrifying time because the headlines were saying, oh, if we default, it's going to lead to this, this, and this. I refused to even do a story on a default because I knew it wasn't going to happen. They talk about it every time they have to raise the debt ceiling, and of course they're never going to just default. They're just going to print more money until they can't do that anymore. So that was kind of a waste of gray hairs for people to worry about them not coming to an agreement. They did, and it's not a great one, but it's something, and we won't default. And that's just not a choice. That's not a choice that they have. And then of course BRICS. This is something I've talked about for a long time. Is the U.S. has really benefited by being the world's reserve currency, and to see that potentially at risk with the Chinese using basically the BRICS countries using other currencies to trade, and particularly in oil. So this has caused a lot of fear, and leading into 2023, people wondering, what do I do under these circumstances? But now fast forward to today, and if you search recession, you're going to see a little bit more positive headlines, and that's amazing. So this is what I came up with from CNN Business. If you notice that on the headline I just showed before, it was also CNN Business saying, oh, there's definitely going to be a recession, and now this headline saying, well, that whole theory is crumbling. And this is something that the economists that I listen to have been saying for a long time, that the economy is too strong for there to be a recession this year. And now that seems to be what we're seeing. This is from Mark Zandi. The economy is incredibly resilient despite all the slings and arrows, despite the banking crisis, rate hikes, the debt ceiling. Zandi is growing more confident that 2023 will not be the year that a downturn would begin. And then with Justin Wolfers, an economic professor at the University of Michigan, he said, we're running out of time to have a recession in 2023. Can't have one when the labor market is running this hot. So let's go ahead and look at how hot that labor market is. Payrolls rose again, 339,000 in May, much better than expected in a resilient labor market. Economists were expecting 190,000 jobs, and we, more than doubled that. It's crazy how strong and resilient the job market has been in spite of all these rate hikes and the Fed's effort to slow things down. So what is causing it? And again, here's the Fed's effort to actually reverse this. It's like I've said, we live in opposite land right now, where normally job creation would be something people celebrated, but now people freak out when there's jobs created, because it means that the Fed isn't getting what it wants, which is to slow down that job growth and create a recession. Basically, it's what they're trying to do, and they have failed after all of these rate hikes. So when you look in the past, I mean, it was only a few years ago that we saw rate hikes in 2017 and 2018, but look at the difference. This is like a staircase that you can walk up. And you look at the one we just had, and you'd have a really hard time on this. It's so steep. It was so fast and furious overnight. It's kind of like driving a car and slowly stopping at the stoplight like I do, or slamming on the brakes like my husband does. One is gentle, the other is rougher. So in this case, it was just a flat out like stomping on the brakes with these rate hikes that went from 0 to over 5% in just a year. Very unprecedented at the pace of rate hikes, with again the intent to stop all this job growth, but it keeps happening. So this was an interesting quote from Logan Mohtashami. He is with Housing Wire. He's the chief lead analyst there. And he says, well, if COVID didn't happen, the total employment numbers in the US would be around 158 to 159 million. Today we stand at 156.1 million. So he says, I think we're still in makeup mode, which kind of helps me understand it a little bit, that look at what happened during COVID. We lost all these jobs. People couldn't work, had to stay home. And over time, those jobs are coming back. And maybe that's what all this job growth is just jobs coming back. At least that's Logan's theory on it. But with that said, we just have record job openings. It's almost 2 jobs for every person that wants one. So again, what's going on? It was only a few years ago that job openings were under 9 million. They were up to 12 million just in just last year. And the Fed rate hikes have effectively helped to reduce some of these job openings, because again, from the Fed's perspective, they want to fight inflation, and a huge way to fight inflation is to kill jobs, because then people can't spend money. It's a terrible plan, but if people don't have a job, they're not going to spend as much. If they're not spending as much, there's not going to be as much inflation. And also, when there's too many job openings, then employers have to hike their pay in order to get employees. We're seeing, some of these, kind of entry-level jobs are paying $15 to $20 an hour, which makes sense with inflation. But of course, that gets passed on to the consumer in the way of inflation. So the Fed has effectively killed a couple million jobs since last year, and that's what they wanted. But it's still a lot. 10 million is still a lot. I think, as I understand it, we need to get down to about 8 million for things to be better from the Fed's perspective. And that would be a couple more jobs disappearing, a couple million more. With all that said, this is one of the most important things that Logan Mohtashami says we need to pay attention to is jobless claims. That if people do start losing their jobs and they can't find a new job, which again, I don't see that as a possibility with 10 million job openings. But if we get to a point where people lose their job and then they can't find a new one, that's when you start to see jobless claims rise. And we are not there yet. We are not at a point where it's any kind of concern. You could see here 232,000 initial jobless claims this month. We need to get closer to this 300 range of jobless claims for it to be a concern, in terms of facing a recession. So this is why economists are saying we're not facing a recession. You can't have a recession when there's this many jobs. You have a recession, like I said, when people lose their jobs and they can't get a new one. But if they can get a new job, then there's no recession. So we're not in one, not with this many jobs. There's obviously a slowdown in manufacturing and in different, obviously in real estate. If you're in a mortgage broker or a real estate agent or in some tech industries, you're definitely feeling a recession right now. But in the overall economy, we're just not even close. So what is happening if there's this many job openings? This was a really interesting article I read from the US Chamber of Commerce. It's called the Great Reshuffling. That's what they are kind of calling this time period that we're in, where there are so many job openings that workers can choose a better life for themselves. They can demand a little bit more of what they want. Maybe they want to continue to work at home, so they ask for that. Or they go to an employer who maybe has better benefits or a better, just climate and working environment. So what we saw last year was 50 million workers quit. And that would be, what that tells you is you're not just going to quit your job if you can't find another one. So 50 million workers quit last year, but their hiring outpaced it. So there was a lot of people who quit, but then a lot more people who were rehired. So again, it's sort of people moving around, finding different jobs that they like better because there's more options. And another example is leisure and hospitality. It lost 1 million jobs in March, but another million hired back. Amazing, right? Again, this is according to the US Chamber. The job sectors that have the most openings, and therefore maybe not enough people who are skilled at these things or want these jobs, but it's healthcare, transportation, and food sector have the highest job openings right now. So where is all this job growth? Well, this is the top metros for job growth from 2022 to 2023 in January. Las Vegas was first, then Dallas, Austin, Fort Worth, Orlando, Nashville, Tampa, Miami, Houston, and Jacksonville. This is from the Bureau of Labor Statistics. You can see a lot of the cities on this list are cities that RealWealth has been very, very active in because of this reason, because there's job growth. But in addition to job growth, it's still pretty affordable in the areas that we're in, like, again, Orlando, Dallas, Fort Worth. Austin's a little expensive. We have a hard time cash flowing there. So even though it's a good job market, we don't have the cash flow there. Same with Miami, might be job growth there, but it's not going to work for us. But the other ones, Tampa, Houston, Jacksonville, these are all cities that you've seen RealWealth be very active in helping investors build their real estate portfolio because of all that job growth. So what in the world is happening? Why is it so hard to kill the economy when the Fed is trying so hard, so aggressively to slow things down, and they get mad every time we get good economic reports like all this job growth? My theory, and I think a lot of people would agree with me on this, is the Fed created exactly what they're trying to fight right now, what they're trying to kill. The tsunami of money that was created since 2020 is absolutely unprecedented. You can see here, if picture this as a tsunami, as an ocean, when big waves come to shore, they wipe things out, and it's just not your normal growth pattern. So it's just far, far, far too much money. I think it was 20 trillion worldwide. It's not just the US Fed banks, or central banks across the world were doing the same thing. So $20 trillion was created internationally, and that money doesn't just sit in countries, right? People buy stuff internationally all the time. So that money circulates. So that's $20 trillion. But just in the US alone, the amount of money that was printed just in this 2-year period was the amount of money that was completely in circulation in before the last Great Recession. So 2007, there was $7 trillion in circulation. That's how much that was just created in a matter of a couple of years. And what happened with that money? Did we get the new roads? Did we get the new schools? Did we get something for it? That's I think some people could argue that this time around a lot of it did go to the people. It went to stimulus checks, and that can certainly create inflation because people spend more if they're getting it. It's not just going into the bank reserves like it did in 2008. A lot of banks just needed to have those reserves in place so they could continue lending. But over the last few years, that money went out, and a huge amount went out in PPP loans to businesses and was spent. So this is an interesting slide because I think it helps to show what's going on out there. This is the annual home ownership rates. As we get into how this affects housing, when you've got that much money circulating, a lot of it went into assets, right? And so those who were able to buy assets kind of benefited from all that money circulating. Those who didn't and weren't able to are just faced with inflation, but not the inflation of the assets they own, which is a good thing, just inflation for stuff they have to buy and need and pay for. So for those who were able to buy assets, this is where a tremendous amount of the money went. So when we look at annual home ownership rates, you can see those over 65 of the highest, it's the highest percentage of homeowners. And then 55 to 64 is next. I mean, this kind of makes sense, right? That hopefully by the time that you're retiring, you own a home and, ideally have it paid off. That's all everyone's goal, right? That's why you want to start young. Start at 30. By the time you're 60, your home will be paid off, or 35. That's the dream. In the United States, in general, the average is here, and then you can see 35 to 40. They're getting going, and now under 35, really big dip over the last decade, but has picked up. But what does this mean when you look at that chart? What this is a fascinating statistic that I just saw. Baby boomers, and this is why there's a lot of boomer jokes. This is why a lot of people hate boomers. Baby boomers hold 50% of the wealth, and they represent 24% of the population. And on the one hand, it makes sense. You've spent your whole life acquiring assets, right? You're over 60, right? Hopefully you have invested and bought assets, and now you can retire, and hopefully you hold a lot of wealth. That's, again, everybody's dream. Don't hate, just emulate, right? Be that. Have your goal for when you want to retire and achieve it. And many, many baby boomers have, although I think it's about 1/4 of baby boomers don't have that. They are not part of this group. They don't have a retirement plan. But for the most part, the boomers are well off. So when you look at this massive group of baby boomers, and I don't know if you can read this tiny little thing here, but it says Gen Z, the youngins, those under, I guess it's 29 now, they've overtaken the millennials by nearly 4 million to become the largest generation in the US. This is a huge thing. This is a good thing for the US to have this kind of demographic, because a lot of other countries like China and Japan do not have this younger generation. So we are blessed. And I personally think, this is my personal opinion, in 20 years, you can call me on it, but you've got this big group of people right here, the millennials, who are forming households, getting married, and having babies. So it's my personal opinion that we are on the cusp of a massive baby boom from these millennials who are getting married, having babies. So I think this chart's going to go like that personally over time, but we shall see. But what is interesting is that Gen Z is a bigger group than the millennials, so we got to pay attention to what they're doing. And baby boomers are the third largest generation with a population of 69 million persons in 2020. So it's probably less today. And with a current population of around 86 million, the Gen Z generation is expected to grow to 88 million over the next 20 years because of migration, according to the United Nations latest world population prospects. Bottom line, the baby boomers are still a really massive, massive group. They have the wealth, and many have paid off their homes. That was the plan, to get to a point in retirement where they'd own their home free and clear. So you have this huge group of people who have the largest amount of homes, and they own them free and clear for the most part. So what does that say about our economy? Well, it's one of the reasons that new listings are down. Look at this. It's just one of the reasons, but when you look historically, this purple line, 2017, it reached 1.3 or over 1.3 million active listings. Then you see 2018, it was less. Then 2019 less. So it was already declining a little. And then 2020 happened, and wow, new listings just stopped. And I think that has a lot to do with the fact that nobody wanted to leave their house to go buy anything or sell anything. So listings dropped a lot. But then in 2021, when people came out of their houses, they still weren't selling. Listings still down. And same for 2022. Of course, it's cyclical. You can see in the summer, in the spring and summer, people tend to put their houses on the market, and then it goes down in the winter. But what we're experiencing in 2023 is pretty flat. So listings continue to decline even at a time when they really should be rising. This is the time where people put their houses on the market, the spring selling season, and it just didn't happen. In fact, it stayed flat and even declined. So this is having a huge effect on the real estate market. And in addition to that, the baby boomers having their homes paid off and they're retired, you've got this lock-in effect for everybody else. 73% of mortgages below 4%, 34% below 3%. Nobody's leaving that. That is an incredible asset. 39% at 3 to 4%, 18% at 4 to 5%, and only 5% over 5%, and only 5% over 6%. So, and the people who do own these mortgages, they are locked into the lowest payments, of course, because they're in such low interest rates. So these homeowners, you know, are historically, when you look historically, they have the lowest payment compared to their disposable income in decades. So Redfin just came out with this report a few days ago, and it says that 1/3 of home buyers are paying cash. So the share of U.S. homes bought in cash sits at a 9-year high. Look at that. Amazing. And I think, of course, that has a lot to do with people saying, you know, I do want to buy, but I don't want to pay these high interest rates, so I'll just pay cash. But who's paying cash? I can assure you it's probably not the Gen Z. It's probably not very many millennials, maybe some Gen Xers, but you know, according to Zonda, it could be these baby boomers, because again, they're the ones holding the assets. They have the equity. They maybe own their home for cash, and they can you know, take money out of it and buy, or just sell their home and take that equity and go buy a house free and clear. So I thought this was really fascinating. And it could be people like me. I mean, we've got a debt fund, not a debt fund, a single family rental fund, where we're raising capital from our investors and we're buying properties with cash. However, we're not seeing a lot of competition out there. And our team just went to the IMN Single Family Rental Conference, and they kind of got the message that a lot of the hedge funds aren't in massive acquisition mode right now because they're maybe more dependent on the financing. So somebody's out there paying cash, and again, it could be the boomers. So we need to pay attention to this group. For the past 40, 50, even 60 years, we've had to pay attention to the boomers because it was such a large generation that when they needed diapers, you know, you should have invested in Pampers. When they came of age and started investing in the stock market, well, that's a lot of people. It took off. You know, the teenagers, you should have invested in you know, potato chips or whatever. And then, of course, with homes, we've seen home prices go up as this massive group has gone through the cycle. But now many are moving to active adult communities. So this is just kind of interesting to see that the active adult communities is the purple line, and the market is the blue line. You can see in Austin, you got boomers, a lot of boomers buying there in active adult communities. Orlando, of course, that's not a surprise. Charlotte, Cape Coral, that's also not a surprise. Nashville, Myrtle Beach, Indianapolis, that did surprise me a little bit. I was a little bit surprised that you know, the boomers would be not moving to the warmer climate, but in this case, it might be they want to be near their kids or their family and friends. Dallas, Atlanta, so you can see the list. Cleveland was one that had fewer boomers moving into active adult communities, and Greenville as well. Okay, now let's talk about Gen Z, again, the largest population. And I thought this chart was interesting that they're starting to buy. Look at this. They're the orange line, and you could see 2015, they were just babies. Again, the oldest of the Gen Z is 29. But now they're buying. And this trend's going to continue. As I said, it's a very large generation, and you see it just continuing to grow. So I think we've seen it at Real Wealth. It's been shocking. I've done a lot of Real Wealth interviews lately with super young people. I've done interviews with people who are retired. I just did one. You got to check it out. I think it's the newest show, the SoFi couple. They're in their early 30s and they're already financially independent. We are seeing more and more young people getting into real estate investing and buying their first home. My daughter is 24 and she just got a big sales commission from what she's been doing. And I said, honey, your sister bought a house at 24, so you need to buy a house at 24. And so she's going to start looking. So I think young people have access to more information today, obviously, than many of us did, and have seen this generation has really seen how real estate prices can go up and how wealth really is created by real estate. There's a lot more education, podcasts, and so forth. So I do expect this line to continue to grow. You can see that millennials are definitely the biggest buyer, but it's slowing down a tiny bit, the growth anyway. Gen X has slowed down. I don't know why. It's just a smaller generation, smaller group of people. But then you can see the baby boomers. You know, it's slowing down, but they're still a large share of purchases. And all of this, all these sales and everything happening at a time when mortgage rates doubled. Like I said earlier, year over year, we've only seen the average home price, and let's face it, there's no such thing as an average home price from the nation, but this is what we use to look at what's going on. And nationally, it is pretty shocking that year over year, prices only went down 1% with this massive increase. I mean, more than doubling, going from 2-3% to 6-7, even 8% in some cases. To have payments doubling and maybe even more, and to still have prices only go down 1%. And in some areas, like I said, in Tampa, went up 5% in spite of just such a massive change to the rate without the prices going down. I mean, it's phenomenal, the strength of the housing market for the reasons I just said. So many people are just staying put, which makes inventory very limited, as I said, listings way down. So with inventory so low, I mean, look at that, just way too low. With the housing inventory so low, those who are able to buy or have help from the boomers, imagine all the money the boomers have that want to help their kids. With limited inventory out there, it's keeping the market afloat. If inventory were up here, it would be a different story. But that's why we look at supply and demand. That's what matters. Green juice. So inventory, if it were higher, and a lot of people mistakenly thought inventory was going to rise, it did a little bit, but they really thought it was going to get out of hand. I wasn't in that camp. I thought there's no way with this lock-in effect and people in these low interest rates, and they're just going to sell their house and buy a more expensive house with double the payment. It's just not going to happen. So a lot of people thought inventory was just going to go crazy this year and that it would crash the housing market, and that absolutely has not happened. So where does that leave us? If people want to buy something, it's going to have to be new inventory. It's going to have to be new homes. So it's important. This is really hard to read, and I apologize for that. Maybe if I get off camera, you can see it better. There we go. You can see new home pending sales. Number one is Dallas. Why is that? Dallas has still this tremendous job growth, but if they have limited for existing inventory, all you can do is build new stuff. So Dallas is number one in new home pending sales. Salt Lake, number two. Raleigh, Charlotte, again, Washington, Sacramento, San Antonio, Cincinnati, Tampa. These are all places you've seen. Baltimore. When you see these kinds of sales, you have to just assume that they have limited existing inventory. One area that I thought was really surprising that was down is Denver, down month over month, 13% in new home sales and 26% But again, Dallas, year over year, 28%. I mean, it's incredible. What's the other big one that stood out? San Francisco. Yep, we know that they've been struggling a bit. Denver and New York. So sales pace, average sales rate, again, you can see here, this is 2019, 2021, and current. And a lot of people, this is Zonda particularly, I love their charts. They like to compare everything to 2019 because that was before these huge variances came to play. So when you compare the sales pace of Salt Lake City to 2019, today to then, you can see it's slowed down quite a bit in the sales pace. And there's only some markets that, let's see, is there any where it's high? Yeah, so Jacksonville, the sales pace is much faster, much higher than it was in 2019. Same with Orlando. And I think this is shocking to a lot of people because 2019 was kind of a normal year. And when you see the sales pace higher than 2019, again, with so much higher interest rates, it's really phenomenal. Look at Charlotte, Tampa, Denver, Atlanta, Dallas, Nashville, just very, very resilient. But with that said, we know that existing homes on the market are so limited that we've got to get new homes on the market, but it's been slowing down. We know that it slowed down dramatically during the Great Recession to a crawl, and it took a while for builders to get back up and running because they got hit so hard. Many went bankrupt, and they finally were getting to a point where they were able to meet demand. And then, of course, COVID happened, and they couldn't get their supplies. They can't get financing. They can't get the materials they need or the labor. So new home starts really slowed down at a time when there's an estimated 6.5 million homes needed. So where does that leave us again as real estate investors in this scenario? We know that for some people, the limited inventory that's out there is still affordable to them, maybe because, again, they're getting help from their parents or they had a lot of equity, or for whatever reason they can still buy, or they're in an affordable market. But for most people, they got priced out. As soon as rates went up, they no longer could own a home and were forced to rent. So at a 3% rate, there was about 82 million people who could afford a $200,000 mortgage, and that dropped to 65 million today at today's rate. And it's a little bit lower even today because the rate's higher than that. So right there, you've got 17 million people priced out, and it's not better, for the $400,000 or $600,000 mortgage. And then this is a shocking slide to show the difference of owning versus renting. When you look at, gosh, this was quite an amazing time during the Great Recession, but it was a time when it was actually cheaper to own than to rent. So I could never understand, well, I mean, people had bad credit, so they couldn't own, they were forced to rent, but if they could find a way to buy a house, it would have been much, much cheaper for them. And that's why if you bought a house and rented it, you had incredible cash flow back then because homes were so cheap, mortgages were low, and the rents were high because there was so much demand. Well, then over time, it became, more expensive to own than rent. There were periods when it was cheaper, and then it got cheaper when rates went really low. But then, of course, when rates started to go up, it became impossible to own versus renting for many, many people. Like I said, at least 17 million. So this is the national cost of owning versus renting monthly mortgage payment for single family starter home versus monthly. So when you see this, it's really sad. It's so sad that so many people are just forced to rent under this situation, when we know that owning assets is what's going to create wealth. Owning versus renting, again, here's 2022 last year. This blue line is home price appreciation. So we saw home prices shoot up. We saw single family rent growth, but wow, apartments really shot up too, because as prices went up, whoops, people couldn't buy even with low rates, and there was hardly any inventory anyway. And you fast forward to today, well, we don't have that appreciation, but we also don't have big declines. So when you double the payment, but you've only gone down, 1% in price, it's just unaffordable. So we saw single family rent growth slow, but it's above apartment rent growth. So again, another interesting chart from John Burns Real Estate Consulting. You can see here single family rent growth month over month. It went up, way too high, not sustainably high. The rent growth was really tough on families, but it has leveled out. But as you can see, rent growth is way above where it was in 2019. And again, according to John Burns, this is where in 2023, year over year rent growth, the dark green is where it's been greater than 10%. And of course, Florida is one of our hot markets. We love Florida. And that is where we're seeing massive rent growth. And we know why. And you can also see it along here, North Carolina and so forth, Jacksonville, all these areas. This is where you've got a lot of people from the Northeast moving down where it's cheaper and, sunnier and way better taxes. So a lot of movement. That's why you're seeing very little rent growth up here, or, just this movement. You can see in the Texas region, it's still green, not quite as strong as Florida, but still green. And surprisingly, Southern California as well. You got Salt Lake, Ogden, Boise. These are not surprises, right? These are all areas where people want to live. So rent index by city, Miami still just firing away. And I think it's just New Yorkers moving to Miami with thick wallets, and they see everything in Miami is cheaper, even though it's gotten much more expensive. It's cheaper than New York City. So entry-level home payment percent of growth, 32%. So in other words, the payment adjusted 32% if you're going to buy a house, but rent went up 11%. So it's going to be a lot more attractive in Miami to rent versus buying. Charlotte, this is one of our hot markets as well. Payments have gone up so much, but rents not as much. So this is an area, again, Charlotte, where people are going to choose to rent. Cincinnati, same thing. Indianapolis, same thing. Columbus, Orlando, Jacksonville. Are you seeing a theme here? These are, again, places where people want to live. Their jobs are there, but owning is just going to be really out of their reach. Austin's the only one that was kind of flat, and that really surprised me. I just can't imagine that Austin is still somewhat affordable to buy, but maybe it's because the salaries there are so high. I don't know. I found that surprising. But everywhere else, it's just tough to buy for most people. All right. This came out, Realtor.com, saying what I've said forever. There's no national housing market. Why? Location matters more than ever. Well, I think it always matters, always has, right? Location. But what I think they're talking about here is that affordability is what's in style more than anything. Real estate markets in the Northeast, Midwest, and Southeast, particularly Florida, are holding up the best, especially in smaller cities where prices are lower. The housing markets that are weaker are in the more expensive parts of the country, such as the West. Home sales in states like California, Idaho, Nevada, and Washington have been affected by the rise in mortgage rates, the higher rates, plus high prices. So yeah, you combine doubling the payment, that the prices aren't coming down. People are just hitting their financial limits, and they're either leaving to go somewhere more affordable or they're renting. So something, again, has to give. And if you want to own a home, people are moving, which brings us to the U-Haul growth index. This is where the U-Hauls are going. In 2022, number one was Texas, no surprise, all the job growth and the affordability. Florida, number two, South Carolina, North Carolina, Virginia, Tennessee, Arizona, Georgia, Ohio, Idaho, Colorado, Utah. And then in last place, where the least U-Hauls are going, is California, Illinois, Michigan, Massachusetts, New York, New Jersey, Maryland. What these states all have in common is very high taxes. So once you add the high prices, high rents, high taxes, like forget it. People are going to go where they pay low taxes or no taxes and where it's still affordable. And again, I bring this slide up because Rich and I jumped into the market and at a time when a lot of people were telling us not to. They were saying Texas, prices never go up in Texas, and they really hadn't. It had stayed pretty flat in 2005, but we just used common sense, and we saw that. Well, and also Robert Kiyosaki was on my podcast, and he recommended Texas, so I guess it was more than common sense. It was what I've done forever, is listening to experts who have more experience than me and follow their advice. So we went against the grain and we just followed what really made sense, which was jobs were moving to Texas, people were moving there, but it was affordable. And even though people laughed at me and said, "Oh my gosh, you're going to lose money, prices will never go up. There's nothing but land. There's going to build, whatever it was that they would say," we did it anyway because this house cost $140,000 at the time, and it rented for $1,500. And A-class schools, it just all made sense, near jobs. And it survived the Great Recession, the biggest housing crash, not what we're experiencing now, which is negative 1%. It was in many cases negative 50, 75%, depending on the area. But our Texas properties cruised right through that recession. The properties stayed rented because they were in good neighborhoods, good schools, near jobs that weren't going away. And those properties ended up tripling, if not quadrupling in price. So people were definitely wrong. They weren't paying attention to the demographic shifts that were happening. But we were, and we really discovered and have been using this philosophy ever since. And it still works today. 20 years later, this is still true. And why I don't fear a recession and why I didn't fear one last year, because I understood the basics of supply and demand. And on top of that, following where the jobs are going, following where the population is going, and where it's still affordable for those people who are moving to those areas. You'll get through a recession that way, especially when those properties cash flow. I don't necessarily think you're going to get rich on cash flow today because it's definitely decreased. As prices go up, generally, rents don't generally go up as quickly as prices. And now with mortgage rates up, you're just not going to see the cash flow we were getting 10 years ago. It's just not going to happen. But as long as the property is covering itself, where someone else is paying your expenses for you, and there's enough money in reserves to pay for repairs, and that over time these properties are going to go up in value because you're buying in an area that's growing, and where there's demand, and where rents will go up with inflation and values will go up with inflation. So if you can buy knowing that the expenses are being covered and there's a little left over to put in your pocket for reserves, this is how you get recession proof. Those cash reserves are vital. I like to see 6 to 12 months reserves per property, meaning if it's vacant for 6 to 12 months, you're going to be okay. Now, the chances of it being vacant in today's market where demand is so high, it's unlikely, but you never know. The Fed's trying hard to make a recession, haven't succeeded, but if they do, having those cash reserves in hand will help you get through any sleepless nights. And then not over leveraging. I don't have a big problem with over leveraging as long as you've got the cash flow from the property to cover it and the cash reserves. But if you ever needed to sell a property for any reason and you borrowed so much that now you wouldn't be able to sell it because the loan is worth more than, let's just say prices went down. That's why people say don't over leverage. So I personally think it's okay to over leverage and get a big loan as long as you are in a position to be able to hold that property if indeed we did end up in a recession next year. And then choose fixed rate loans. This is key. Even today with rates where they are, locking it in, I think, is wise because you can always refi into a lower rate or pay points and pay that rate down, which I'll talk about in a minute. But fixing the rate is really important. I'll talk about why it's so important in just a minute. And then, of course, the right market matters. So being in landlord-friendly areas where you can collect rent, where the government can't come in and say, you know what, the tenant's more important than you, more valuable than you, so they're not going to pay. You have to pay your expenses. They don't have to. This is where I live in California, and it's tough to be a buy and hold investor in California. So being in the right market where landlords are respected, where people do have to pay their rent because they know the landlord has to pay their bills, being in a low tax place that's job friendly, this is to me very, very important. So where are we now with inflation, and is the Fed going to keep raising rates? This is a question that people have had for a while. We know that inflation is trending down. So even though the reports and the headlines don't show this graph, this is good. This is really, really good. This is from June of last year till now. It's going in the right direction. So it is working. It's just not at the 2% that the Fed wants, but definitely trending in the right direction. So the big question is this trend going to continue? I mean, that's what everybody wants to know, right? And that's why some people think, oh my gosh, the Fed's going to raise rates again because Canada just raised their rates and they can't fight inflation or whatever it is. But when you see this chart, it does give a little pause, right? That maybe what the Fed is doing is working. I listen to a lot of really smart people, and one is Barry Habib from MBS Highway. And he believes that by this summer, we're really going to have inflation in check. And a lot of that has to do with comparing year over year. So if we compare year over year inflation trends from this to this, we're going to look good. Inflation's going to look amazing, like it's gone down. Whereas last year in June, we were comparing this to like a 2% level. So yeah, the difference was horrible to go from 2% to 9%, but from 9% to 5%, the year over year is going to look much better. So Barry Habib really believes that by summer, these numbers are going to look great. We have a lot of the problems behind us. The rent growth that we saw wasn't really showing up so much in the inflation reports because rents don't change overnight. People are on leases, but as those leases come up and the new rents come in, that's helping as well with inflation, with shelter costs. And what Barry Habib says is that mortgage rates follow inflation. And when you look at this is from Freddie Mac Bureau of Labor Statistics. You've got mortgage rates and inflation. You can see that they kind of do a dance together. And the reason for that is pretty much that mortgages are tied to the 10-year treasury, and because people who buy the 10-year treasury also buy mortgage-backed securities. And when people think that there's going to be inflation, they don't want to be in something that yields less than inflation. They have to be in inflationary type things. So if inflation's at 9%, they're going to go in this stock market where those things are costing 9%, right? So they're going to invest in companies that are having that kind of inflation because that's how they'll at least not lose money. But as they see inflation coming down, then they go back to buying bonds because that generally means that things are slowing down, that we could be facing recession, and they go to the safety of mortgage-backed securities. So if it's true that inflation will continue this downtrend, then it could also mean that we would see mortgage rates coming down sometime this summer, which Barry believes. And if that happens, we've just priced in millions more people into the market, which is great, except that there's no inventory for them, right? So that could mean that you've got all these people who now can afford to come back into the housing market to buy. They don't have to be renters anymore, but the inventory is really not there for them, which could mean potentially bidding wars again this summer and fall. So we shall see. This is something I actually believe is true, and why we've been saying at RealWealth for a while. Take advantage of the fear in the air, take advantage of the lack of competition, and get in there because it could change pretty rapidly given the just dearth of properties. It's scary. You know, I look at my daughter, my older daughter, who's 30, who has a family. She's pregnant with my grandbaby, little girl this time, and the 3-year-old, my grandson, and they have 2 dogs. One is huge. It would be really hard for them to rent because no one wants big dogs. And I think he's part pit bull, so there's issues there. and then 2 kids, and it's like, oh, you don't know if you're going to get booted or if rents are going to go up. So last year, even though she was at the peak, prices were at the peak, I just said, honey, there's like 3 houses on the market. Just get one of them, because at least you're locked in and you don't have to worry. And this is millions of millennials in the same situation. There's forming families, they've got animals, they want to buy. They don't want to be in a situation where there isn't a house for them, right? Because there's such limited supply. So I really do believe it could be this summer that we see rates go down and people diving back in. Every time rates go down a little bit, we see sales go way up and bidding wars. And again, this is why we created our single family rental fund, because it was like last May, I was sitting with Leah Slaughter from Dallas, and we were at our live event in, I think it was Tampa, and we're looking at each other like, oh my gosh, with these rates going up, there's going to be demand for rentals. We need to start this fund. And we did. We've raised millions of dollars to be able to go buy properties that would be hard for a first-time homeowner to buy, because the bank wouldn't probably finance them, because maybe the bathroom's not working or the kitchen needs something and it wouldn't pass inspection. So we're able to pay cash, fix them up really cheaply, make them nice like this, and rent to these high income earning people that are coming in for the chip manufacturing that's coming into the North Dallas area and everything else. There's so much growth. So we knew this was going to be an opportunity, and we were completely right. It has been like almost zero competition. The deals that Leah's getting are mind-blowing, and the rents are coming in higher. There's still an opportunity to invest just for a little bit longer. It's going to close this fall. So growdevelopments.com if you want to find out about that. But that is why we jumped in, and we know that some Wall Street firms are doing the same, with Blackstone gearing up to purchase single family rentals with $110 billion. I have heard that this is inaccurate, but it's still something to think about, that MetLife Investment Management predicts it will grow to 40% institutional investors in a single family rental space. Right now, it's only like 3%. So I find that hard to believe. Someone just told me last weekend, it's not real, but I don't know. Who knows? All right, so to give you an idea of what kind of featured properties are out there with RealWealth, I mean, these are just some examples. In Jacksonville, sales price $254,000, rent $1,625. The builder is offering, just for one more week, a 4.75% interest rate. Can you believe that? I just forwarded this to Rich so that if nobody buys it, we're going to get it at that rate. That's crazy. So just know that that deal is going to be over soon. They kind of worked out a deal with the builder, with a lender, where they're paying the fees so that the investors can make the numbers work. And Jacksonville, as you saw on all the lists I just showed, is one of those super fast growing areas. So again, nobody buys it, it's sold to me. Rockport, Indiana is a duplex. Again, Indianapolis is one of those areas that kept showing up on all my lists too. I didn't try that. That is how these lists came to me. I wasn't just asking for the markets that we're in. Just Indianapolis is a hot market, and our Indianapolis team can tell you why. I know there's a lot of biotech growth there. FedEx is headquartered there, but whatever it is, it just keeps growing. This is a duplex for $399. It's incredible. With estimated rent at $2,950 at 8% cap rate approximately, and nearly sold out development in the area with a housing shortage. So again, these are the kinds of things that you can still buy out there, which is, I think, phenomenal, given how much prices have gone up, that you can still not only break even, but cash flow in this environment, and then you can refi later. Okay, so where are the cracks in real estate, and what are the headlines talking about? Well, commercial real estate is really, really in a lot of trouble right now, mainly because most commercial real estate is on adjustable loans. Many were on bridge loans, where they would basically flip apartments. They'd buy an apartment, want to fix it up, so they'd get a bridge loan that would kind of help them with the fix it, and then they would refi or sell. So most commercial properties are on these adjustable rates. And as the Fed has been raising rates from 0 to 5%, Well, that's how their rates have gone up, and rate caps. So I'll just read this. I'm sure you guys have heard about this $229 million multifamily property that was foreclosed on. I think it was like 3,200 units by a multifamily syndicator. I think they were like C class. Those are really tough to manage anyway in Houston, let alone 3,200 units. Yikes. But this is what they were faced with. Prices for caps have surged as the U.S. Central Bank has raised rates. For a 3-year, $100 million interest rate cap tied to the secured overnight finance rate. So the SOFR is what the interest rate is tied to in commercial property usually. And since you're on adjustable rates, commercial property, banks will usually require that you buy a rate cap, basically saying that if rates go past a certain level, it's capped if you pay this insurance. A lot of people didn't even buy the rate cap, so they went from maybe a 2 or 3% to an 8 or 9% on a $100 million mortgage. I mean, they're just that alone. If they didn't buy rate caps, they're in big trouble. But even if they did or have to renew, prices averaged $2.2 million in October, up from $200,000 a year earlier or $45,000 2 years ago. So you would buy this rate cap and pay $45,000. Your pro forma works. Now you pay $2.2 million just for insurance, and the numbers don't work. So, and then a lot of these were bridge loans that were due, and people had to refi into these higher rates. So again, this was the first of what could be more. But what's interesting here is it's the adjustable rate. Almost, I was just to say, most single family or 1 to 4 unit is on fixed, and most of them 30-year fixed with people with really high credit scores and low, low rates. But with commercial, it's adjustable. And this is exactly what brought down the residential housing market in 2009, because most people were unadjustable back then. So Rich and I mean, especially Rich, he is really adamant about getting at least a 10-year fixed, but most of our properties are on 30-year because he just wants that security. And that's what a lot of you have, I know. But commercial real estate is really going to be feeling some pain. I'm just cautioning people that, make sure you stress test if you're going to do any commercial real estate. Make sure that you really do best case, worst case scenario. If you're going to invest with somebody else, review the docs with an attorney to make sure that you really understand, and that you understand the pro forma. Maybe have an underwriter go over it with you so you really know what you're getting into. That the pro forma has high reserves set aside for surprises. And ideally, I've seen a lot of people buying, kind of taking over loans that are fixed rate. There are some fixed rate loans out there on multifamily and on commercial. So I'm seeing people buy those, but just again, fixed rate gives you a lot more security than adjustable. All right, so once again, we've got upcoming webinars, Tampa on this next Thursday, and then what's happening with interest rates the following week on the 22nd. And then of course, our big 20-year anniversary party. I hope you can make it October 6th and 7th, right at LAX. There's a hotel right there. You can literally walk to it from Southwest, and we're just going to have a great time and celebrate 20 years of real wealth. So now I will take questions. I will come back on. Hello. And let's get through these questions. All right, Kathy, how the decision by the government of raising the debt ceiling will impact the economy and especially real estate? Hey, Mauricio, and it'll be fun to see you this weekend. All right. Well, let's just say that our politicians love debt, and they love to spend money. And I think I was reading they're even considering removing the debt ceiling because, hey, why have a ceiling to how much debt you have, even though it's unprecedented? So all I know is that our politicians love to spend money. Americans love benefits, and I don't see it changing. So how does that affect real estate? Right now, the only way to pay our debt and the only way to pay our bills is literally printing money or increasing output. So are we seeing more and more states be pro-business? Well, I hope so, but I know that we're doing some reshoring, which would make a big difference. So if we can increase output in the US, that could help. But for now, I think that the way that politicians have been paying for all the things, all the services, all the benefits, is by printing money. And printing money generally creates inflation. Inflation is nothing new at all. I've said several times that when I started investing 20 years ago, the average home price was 1/3 of what it is today. That was 20 years ago. I thought things would double every 12 years. So I guess you could say that we're on that. Again, inflation is nothing new. People have said asset values are going to double every 12 years or so. That's what we're seeing. We're seeing it more rapidly. And that is a direct result of all this money printing. So people who vote for these benefits are paying through it through inflation. And it's really unfortunate. There needs to be more financial education out there to see, like, you are paying for it. It's not the wealthy that are going to pay. They're not, well, the wealthy know how to avoid taxes. Believe me, there's lots of ways to do that. It's everybody else is paying through inflation. And unfortunately, that's how it's going to go, which to me means that hard assets are just going to continue to go up in value. Not so much that they're going up in value, but the dollar, the purchasing power is going down because of the devaluation of the dollar. That's just my opinion. Are rates heading lower? Fed seems to have completed raising rates. So in this case, I know you're talking about the Fed rate, and that affects, the short-term rates like I talked about, and credit cards, car loans, and commercial real estate, and obviously in the slowing down of the economy. So when we're talking about the overnight lending rate, it's my personal opinion that we don't know. We don't know. I really, like I said, I really believe that inflation is going to look a lot better this summer, and that may have the Fed pause. But if that's not the case and we don't see it, they could continue to raise. I don't think they will. I think they're going to hold here. They've said 5.25 was their target. So I really think they're just going to hold and see how things go. There's some people saying that they're going to start reducing and cutting. I don't think so. I think they're going to hold right here all year. There's a teeny chance that they would, if inflation is not getting under control, that they would raise by another 0.25%. But I think that they're going to wait a little while to make sure the banking system is solid and so forth. Although Canada just raised rates and shocked people. And most Canadian real estate is on adjustable rates. So every time they raise rates in Canada, it's super painful for everybody. All right, that's my thoughts on it. On your baby boomers hold 50% wealth chart referencing the size of generations, Gen Z comprises 20 years of population, which is larger than most of other generations, which were around 15 to 17 years. Not a critique on your slide. Gen Z is still by far larger per annum, but just an observation. Yeah, I don't know who decides. It seems like it should just be super set, like, I know John Burns really tried to do that. He tried to just make it every 10 years is a new generation, and they have their own. Things are changing so quickly that my daughters are 7 years apart, and they are like completely different generations, which they really actually are. One's a millennial and one is a Gen Zer. But John Burns really tried to put some order to what we call generations, and he tried to do it every 10 years, but it just didn't take off. I don't know who decides this stuff, but nobody really knows the exact numbers of what a millennial is and a Gen Z. But that was a slide that, who did I get that one from? That last one was Zonda. So they do some pretty thorough research. So I don't know, that was their belief, but either way, it's great that Gen Z is a large generation. It's going to keep America afloat while other countries suffer as they don't have the workers that they need. And again, with my theory that we're going to have a baby boom over the next 3, 4, or 5 years, that next generation could be pretty big too. Is the Florida growth sustainable with hurricane risk? I hope Tampa can sustain a Cat 5 hurricane. Tampa got lucky, but there's always risk. What are your thoughts? I ask that every single day that I live in California, living on a fault line. San Francisco's on a fault line, Oakland's on a fault line, LA. We're crazy, right? And most people don't have earthquake insurance. So people seem to just take the risk. I live in a fire zone on a fault line. So I've got the double risk. So with hurricanes, Floridians just don't seem to worry about it, which is amazing to me. What is happening is definitely insurance rates are going up across the board, definitely going up in Florida, definitely in California, and sometimes you can't even get it, or you can't get completely covered. I don't think we're completely covered on our home here because they only insure to a certain amount. So yes, there's absolute risk, but if you ask a Floridian, they just kind of don't worry about it, just like you talk to a Californian and they don't worry about earthquake. So personally, at RealWealth, we really recommend that you not invest in flood zones anywhere, but specifically in Florida. And I do like being a little bit inland. I certainly wouldn't buy beachfront in Florida. For all the stats you've shared about cities, are they for metro areas, including suburbs, or just those cities proper? Very good question. I'd have to go back through the slides and see if it said metro or not. Looking to buy single family in Tampa or Jacksonville, do you think all the people that move there will stay with environmental risks? I did hear for a while that people from New York and from the Northeast would move to Florida and find it to be too hot and humid, and then they would boomerang, is what they call it, and they would move back to North Carolina, which I think is one of the reasons why the northern coast, above Florida, is booming as well, because maybe not as hot, not as humid, maybe not as much risk. But like I said, Tampa and Jacksonville are not slowing. Even after the last hurricane, it's not slowing down. So at least we're not seeing that. Anything could change or happen there. I don't know if my observation is right, but in Texas, like Frisco and Plano, I see that you get better pricing for houses that are under a decade old than brand new. So if we want to buy for investment purposes, which ones do you recommend in Texas? I've done both. I have bought a lot of new homes, and the beauty of a new home is that it's new. So you almost don't have to even worry about repairs for a little while, especially that first year. You're under warranty, and then some things are under warranty for 10 years in some cases, and tenants love new homes. So I personally love buying new homes, and you just have to know that initially your cash flow is not as good, right? Because the price is probably higher, but over time it can work out better. Like with our single family rental fund that we had before that we just closed, we bought a bunch of new homes in Florida and they performed incredibly. Because over time, the first year pro forma doesn't look good, for sure, it looks terrible. But over time, the new home rents tend to go up faster. You have fewer repairs. They tend to be in nice areas. And we have just seen over the long haul that the new homes can work out better financially. But in the case of Texas, there's just such limited inventory. Sometimes that's all you can buy, although our fund is buying older homes. So, it's just up to you. If you buy an older home, you've got to make sure that you've got a full inspection and you know what kind of repairs are going to be needed, and set that aside so that you're not surprised when they happen. Because trust me, new homes need repairs, but older homes do too, even more so. Can you recommend some websites, podcasts, or other YouTube channels that you listen to or recommend we listen to? There's so many. You probably know I'm on Bigger Pockets on the Market. I think, we have a lot of different perspectives there. I like that. And of course, anything Bigger Pockets is great. But if you're talking about, it just depends on what topic. If you could just clarify your question a little bit more on what specifically you're wanting to learn on those podcasts, I'll give you some recommendations. I know the early part of this year and later part of last year, the interest rate cap had skyrocketed. How is it in the past month since people expected the Fed to finish hiking? I don't know if you heard my interview on the Real Wealth show with a commercial lender. I thought it was a really interesting interview. And he did not think that the rate caps were going to calm down until it was certain that the Fed was going to pause, and that is not certain yet. So I can't tell you right now. I'm not sure what the change is. All I know is that a month ago, it was still real bad. So I don't know that it's changed yet. How many maximum single family properties can I buy with a mortgage if I can afford the down payment? Fannie and Freddie will give you up to 10. investor loans, or loans basically. And so if you've got a primary, you can get 9 investor loans. If you're married, each of you can have 10 if you can qualify on your own. After that, you have to go to a portfolio type lender, and we have those on our website as well. Be sure to talk to a RealWealth investment counselor about how to get a DSCR loan, which is basically a loan that loans to the property. The rates tend to be higher, so you want to max out your Fannie Freddie loans. Max out your 10 loans before you go to the DSCR, which is debt service coverage ratio loans, which look at the income that the property produces versus comps. So they look at comps too. All right. Recent bank failures have caused banks to cut back on lending and increase their reserves. This helps slow the economy, so the Fed might not have to increase rates as much because the banks are doing the Fed's job. It's a really good point. Banks are being really cautious, and when they're not lending as much, it's all a part of the cycle that we're in. Just over the last 3, not last year, but before that, during COVID, it was in an expanding cycle where interest rates were low, and the intention was to get the economy going and have rates so low that people borrow money. When rates go up, people borrow less money, and that really slows down the money that's in circulation. So that's all part of the plan, that the banks would lend less. That's generally what happens when rates go up. So yes, it's part of the tightening process that we're in. How do the returns of the Dallas fund compare to the returns of the single family homes in North Dallas through RealWealth Network? That's a good question. Our target that we put on our page says 8% target IRR, 8% per year, and that's at the end of the fund, so that would include appreciation. We're way overshooting that. In fact, the appreciation that we were projecting in the pro forma, we got in year 1 on the purchases, because we got the property so cheap that what we believe is the built-in equity is what we thought would be the built-in equity over the 5-year term. So whatever happens from here on out is going to be just even higher return than we expected. So the difference between the fund and buying just on your own is that they're different product. Leah and the Texas team is really uncomfortable having investors buy a house that's not renovated yet. They want to, that's all being done in the fund, where we're buying properties that need quite a lot of work. And that's not what they want investors to be doing. So it's a different product and probably in different areas. So I'm not sure what her stuff is projecting, but I can tell you we've been projecting 8%, but like I said, we've already got the equity we were expecting in year 1. We were expecting in 5 years. With Fannie and Freddie loans for single family, do they look at your rental income as income for mortgages? You need to talk to a lender about that. But yes, it helps certainly to have property that's cash flowing, and usually it's 75% of that rental income, but definitely talk to a lender. We have a whole list of lenders at realwealth.com that just look under resources. I was looking for good websites, podcasts, YouTube channels to listen to under macroeconomics, single family real estate, and real estate news. Well, like I said, then my On the Market with Bigger Pockets addresses a lot of that. Of course, the Real Wealth Show, I'm always interviewing economists and talking about single family rentals. So you'll get a lot of information there. I really like Housing Wire. They have they're really focused on single family, and that's where Logan Mohtashami's on a lot, and I like to follow him as well. Trying to figure out if we're going to sell a small portfolio of 8 doors that isn't performing. I would love to talk to someone who could help me evaluate options. I'm not sure where this is, but in terms of looking at how that current property is performing versus what it could do, I think our investment counselors could help with that, to just see, well, if you sold it, if it's negative cash flow or it's needing repair or whatever the problem is with the current property, if you were to sell that and acquire something else, we can certainly help you see the difference in what you're getting now and what you could get through other properties. And you just go to realwealth.com, and you should have an investment counselor that you can work with at RealWealth. They're really, all of them are experienced investors themselves. They bought through our network and can really help you with that question. They help investors with that kind of question all the time. Okay, everyone, that's it on the questions. It's 1:20. Thank you so much for joining me here today for the housing update. To summarize it, we're really in the right asset class, in my opinion, with those fixed rates, with the low supply, the high demand. I just don't see things slowing down anytime soon, and especially with this group of Gen Zers right behind the millennials who are already purchasing. I feel very confident. And then on the other end, with the baby boomers living longer and having all this extra money to invest in all these new ways to stay young forever. I just I don't think that single family is going to go out of style anytime soon. All right, have a wonderful day, everyone, and I will see you hopefully soon. Bye-bye.